Okay, ladies and gentlemen, boys and girls, we are here. We are live. Thank you, all of you, for tuning in tonight, or this afternoon, or this evening, or this morning, wherever you are in the world. Thank you so much for tuning in. I'm really, really grateful. Okay, so today is the property and finance live stream. So some of you who aren't aware, I've got Kwasi and I've got Michael with me this evening. Kwasi and Michael were previous guests of mine from season 2 of the Sound of Accra podcast. And tonight I've decided to bring them back to back. I mean, on season 2, we had a back-to-back episode where we just focused on finance. So it was Kwasi, I believe, and then it was Michael's episode afterwards. But I decided, you know what, let's bring these two superstars together on one panel. We're also going to have another gentleman join us, but unfortunately he wasn't able to join us. But not to worry, free's a crowd, and we are here for the run. Kwasi, Michael, how you guys doing tonight?
Great, thanks.
I'm good, man. I'm good, man. Good to see you. Good to see you too.
Likewise. It's been a while. I mean, I think we've all kind of been able to get a haircut, I guess, since the pandemic. It's been a while. It's been such a while, man. Like, you know, you just locked down, you saw people whose throws are just going out of control, like Loch Ness, and now we're all kind of patterned up. We're able to go outside, and we've been able to get some freedom again. But more importantly, tonight, financial freedom. That's the focus of tonight. Property and finance. So I'm sure those of you who are aware, or unless you live in Iraq, we're in there's a little bit of uncertainty again. We're not talking about COVID, but we're more talking about inflation, rising costs of goods, commodities, fuel. I mean, you guys saw it a few weeks ago, people fighting over fuel. It was crazy, but now we're starting to see a little bit of a shake up in some of the economic markets. And who else to get on than some experts to really just dive into some of these topics that we have. But before we get into that, can you guys let us know, where you're tuning in from, where you're listening from, the city, the town, the nation that you're in. Drop a comment in the discussion chat. Hit the like button, hit the heart button, whatever button that you can see. Let us know that you're here, you're live with us tonight. And if you have any questions for these gentlemen as well, please do get your questions in the chat. And then I'm sure Michael and Kwasi will be more than happy to answer any questions that you have in relation to property and finance, to the best of their ability. So please do get your questions in the chat. I'm going to leave it in the ticker. So before we get into today's discussion, for those of you in the audience who may not know about Michael or Kwasi, I'm just going to get them to do a quick recap. Not even a recap, just a quick pitch about who they are and what they've been up to recently. Michael, just give a quick elevator pitch to the audience about who you are and what you've been up to recently.
Yeah, hi everyone. I'm Michael. I'm a financial advisor. I've been in that space for about 4.5, almost 5 years now. I've been working in finance for about 12 years. And, I've just been adjusting really with the lockdown, working from home, actively working with my clients and just, regularly, meeting new people and getting back into the world pretty much, lot of Zoom calls. So trying to get back out on my feet and use my feet more often. So yeah, all good.
Excellent. Thank you for sharing, Michael. Kwasi, if you don't mind.
Yeah, my name's Kwasi. I work in investment banking. I do strategy. Separately, I'm an entrepreneur. I've got my hand in a few different pies, namely, not least property, which is what this conversation is going to focus on today.
Yeah.
I guess the upshot is, I'm probably like a lot of people out there in that I have a career, but also I dabble in a few different things, trying to build that prosperity, trying to build that long-term generational wealth, and just trying to achieve that financial well-being.
Awesome. Yeah. How does it go in your show? Turning is it turning is it
Dreams
some
into income streams.
Jeez, there you go, baby,
I
biggie,
like that.
biggie.
I like that.
Yeah.
Yeah.
You're turning dreams into income streams. I love it.
Yeah, I mean,
Perfect.
you know, for me, the thing is, like, since I was a kid, one of my one of my memories in school. I remember I used to go to Safeways, as it was. I probably just
Safeway,
dated
wow.
myself, but most people don't
Safeways,
even know
those are
what
the
that is.
days. Wow.
Yeah, I used to go to Safeways with my mum, and back then I used to love Hubba Bubba. Again, probably dating myself, but I used to
Love it.
love these Hubba Bubba, and I'd go there with
Yeah.
my mum, and I'd buy a box of Hubba Bubba in Safeways, and I'd take it to school, and I'd sell each individual one, and that was when I was maybe like 13. But that, you know, so that's how I achieved my dreams. Back then, my dreams were all about music, actually. So I used to
Yeah.
flip these sweets and then use the money to go buy CDs and tapes in
Yeah.
Virgin. Again, dating
Virgin
myself,
Megastores.
but yeah.
Oh man, such a while ago. I did something similar. When I was at school, I used to sell I hope the police isn't watching. I used to sell bootleg CDs and albums and stuff. So it's like I'll make £70 a week and I'll spend it on JD Sports. So it was terrible, like terrible what do you call it? Way to spend money, but at least I knew how to reinvest the money back into buying more CDs from Lidl. It's crazy. So I'm making £70 a week. I remember I spent it on one jacket, and it was freeze. It was winter, and I was wearing like a bomber, like a night bomber jacket, and it was just man, it was crazy. But yeah, I miss those days, man. Like, go on.
I was a saver, man. I
Saver.
didn't used to save all my money, man. I don't know why. I think it was because I had an older brother that used to get, you know, the firstborn. He used to get what was asked of him. You know, if he wanted something, the parents would get it for him. And I always felt like I had to get things for myself, and I just got used to like keeping my money and just trying to keep it and you know, kind of put it together so I can buy something at some point. And I just got used to saving for the sake of saving, which was a bit weird. Yeah, man. And it just always left me with a little bit of money on the side so that I can get stuff done if I wanted to during back when I was younger. You know, crazy times, man.
Crazy times. And I think that's a perfect segue into our into the discussion. So those of you listening, those of you who just tuned in, thank you so much. If you're watching the YouTube, LinkedIn, or Facebook, please hit that like button, the heart button, the engagement button, so that we can get this content out to people who need to hear financial literacy, who need to hear information about, you know, making the most out of their money, making the most out of investing, etc. And also, please leave a comment. Let us know where you're listening from. If you've got a question relating to property, finance, investing, Michael and Kwasi, they'll do the best that they can to assist you tonight. So we're going to continue the discussion. So yeah, Michael, you mentioned you know, saving back then. I'll be honest, I wasn't a great saver. I was more of a great spender. Hey, big spender. But anyway, I think saving is one of the oldest tricks in the books, right? But then, of course, you know that as the years go by, saving isn't enough. So, for example, what will happen is that you leave your money in the bank, but then, of course, inflation is taking place. So the money in the bank is not really, you know, it's probably losing value whilst it's just sitting in the bank. And of course, that's where people like yourself, Michael, will probably come in, or even Kwasi, where you're showing people how they can make their idle money work harder, if that makes sense. So if, of course, like the average person knows about the ISA and, you know, maybe buying stocks, but even stocks, you know, they may not even know what kind of stocks to get sometimes. What would you say are some kind of, I'm sure Kwasi, I'm sure you're just as good as in this question as well. What are some simple strategies that, you know, the average person can use to, you know, to take the money they have in the bank and to let that make a bit more money? Maybe whether it could be 5% interest, 8% interest in such a time as this, where, you know, inflation is probably eating up more of their financial power, if that makes sense.
I guess maybe I'll start and then I'll give a quick answer and then I'll give it to the expert in the space, Michael, to kind of elaborate and go into more detail. But I think the thing I always say to people is not enough people use their tax-free allowances. By that, I mean, in particular, your stocks and shares ISA, your cash ISA, your junior ISA, I think there are a couple more other ISAs. I'm sure Michael will go into it. But this is where you save and you don't pay tax on your earnings from your savings. Massive thing, because capital gains tax can eat into your profits. And often ISAs as well are really low cost. So cost and charges and tax are probably two of the ways that can erode when you're building wealth.
Yeah.
And something like an ISA actually takes one away and reduces one massively.
Wow.
So I always say, my first point of call is people should be trying to max out their ISA. In terms of return, I mean, if you're investing in the stock market, obviously the value of your investments can go up as well as down. And the past is not a predictor of the future performance of any investment. But typically the stock market will do, if you have an index tracker, so you can go for like a FTSE 100 index tracker or MSCI global tracker, something that's tracking the global markets. Relatively low risk. I say relatively. It's going to probably match at best inflation, maybe possibly beat it. But it's tax free. So I think that's probably, for me, the thing I always say is the easiest and most obvious way for people to start investing, getting exposure to the equities market and start building wealth, really.
Okay, so I think the key takeaway I got from there is looking at some tax-free options in terms of like taking the money they have in the bank and using that to gain some interest in that sense. Some very good options there, Kwasi. Thanks for sharing. Michael, of course, feel free to share some. Of course, if people really want to deep dive, of course, they should definitely book a meeting, book a consultation with Michael, and see how you can work together with Michael. So Michael is a financial advisor for those of you who aren't aware. But yeah, Michael, I'm sure you're happy to share some some simple methods or some methods that beginners can look at.
Yeah, definitely. I mean, Kwasi started off very well. The ISAs are a great place to start because of the tax benefits that you get there, and they can be quite straightforward to open up. And depending on which one you have a limit every year that you can max out, which is still very high. ISAs are £20,000, and that's for cash ISAs as well as stocks and shares ISAs. Then you have lifetime ISAs as well. But a lot of people always tend to forget about pensions, and sometimes pension is a bit of a dirty word depending on the generation that you're from. But the reality is, pension also is a tax efficient vehicle that you can use to invest for the long term. It is a long-term investment, but similar to the ISA, you do get the tax-free benefits as well on the growth from an income and a capital perspective as well. So it is about just utilizing the vehicles that are available to you. Obviously, there are others that you could potentially tap into, but if we're talking about people that are kind of looking to start for the first time, then you really want to kind of start with the basics and just get a foundation in place. You don't want to make things too complicated for yourself. So even using the tracker funds or index funds like Kwasi mentioned is probably more beneficial because of the diversification from a risk perspective, as opposed to going out and building your own portfolio, which is fine if you want to start picking stocks and tapping into that space. But the more stocks you have, the more individual costs you need to take into account, the more different companies you need to stay on top of as well.
That's a good point there. I think one good option, maybe this is a little bit above the whole above the ideas that both you shared. One option that I know some people have shared in the past is I think is it index fund? So is it the this when you purchase a bundle of stocks from the top tech companies? So was it Apple, Google? What is that called again?
An index, yeah. So
index, yeah.
You get a basket. So there's two different types, I guess. You can get an index fund, which is basically a basket of stocks, or an index tracker fund. Basket of stocks that will track. You can also get something called ETFs, exchange traded funds. ETFs are similar, but maybe a little bit more advanced in that you can get ETFs for like you're suggesting there, the tech big US tech companies, or you can get an ETF. You can even get an ETF specifically that is sort of focused on companies that are going to beat inflation. So we're talking about inflation.
Yeah.
You can get things that are called inverse ETFs, so that if you want to bet, if you think the US tech market is going to go down, you can get an inverse ETF, which would do the opposite of what the tech stock market. So there's, as you go up the food chain, there's lots of the complications and the complexity increases. I think probably beyond, so you have basic index tracker funds, more complicated ETFs, and then beyond that you get into the kind of the realm of the individual stock picking that Michael was talking about, where you need to do sort of analyze each equity, each stock individually, look at the idiosyncrasies of that particular company, what's going to happen, what measure that, and then invest in that, and then track that, and then monitor that, and then add more. So it's a lot more work building a portfolio of individual stocks. There's levels, I guess. There's levels to this, and you just need to kind of be humble and start at the bottom and just work your way up.
Yeah, that's fantastic.
Yeah, you need to take your time. I mean, you really need to just be patient with it, and start with something that you can get familiar with. And with some of these kind of trackers, it's a bit easier to start tracking and just understand the price movement, as opposed to focus too much on the underlying investments under it. And even if you feel that there's too much there, if you do want to really get comfortable in investing, I think I always tell people to invest in something that you have an interest in, invest in an area that you have a passion in. So find companies that are aligned with your interests. If you like books, and maybe look for a publishing company. If you like tech, maybe look for a technology company, a Facebook, or some of these other kind of companies. If you're into Netflix, Netflix is low at the moment. It could be a buying opportunity. You never know. So I think it is about kind of staying in the area that you have a bit of interest in, so it doesn't feel like too much work, because
great advice.
For experience, it can be very heavy, in terms of doing the full analysis. If you're looking at fundamentals and really trying to take into account understanding what a valued investment is or growth investment is, it's a lot to really take on board.
Great place to start. Great advice, Kwasi and Michael. Thank you so much. And there is levels to this, just like Kwasi said. There is levels to it. I mean, the more riskier, I guess, investment probably that you take, the more moving parts, the more work that you have to put in, to make those gains, or to even maintain, some of those gains that you've been making. It's a very interesting one, and I think it's I mean, just as Kwasi mentioned, how how more work, how complicated it can get, where you have to kind of like keep, you have to monitor different companies, see how they're doing. You have to, you have to keep watching the markets and the stock prices and stuff like that. I guess you could also compare it to crypto a little bit. With cryptocurrency, for example, I mean, there's lots of different projects, behind the different coins, and then there's lots of people that will try and manipulate the market. There's lots of different there's the Bitcoin, and then there's the altcoins, and then there's and then you have the communities behind it. I mean, there's a lot of moving parts that you need to watch as well. So I think with stocks and crypto, I do see a lot of parallels in that sense, but of course with cryptocurrency, of course, is a bit different to how the stock market work a little bit. So yeah, that's a good way to start the conversation as well. So let's go into some individual questions. By the way, those of you guys who are watching or just tuning in, thank you so much for tuning in. Just please hit the like button if you're still watching, so we can get this content out to people who need to hear it. Let us know where you're coming from. If you have any questions related to finance, property, or investing, please get it in the chat below so we can get your question over to the panel. Other than that, we're going to continue the conversation, and please do keep it locked here. We do have some good discussions coming your way, so please do not go away. You're gonna enjoy this show tonight. So Michael, let's kick this off. I want to give some individual questions, and also some group questions as well. And of course, when the audience stops dropping some questions through, then we're gonna mix up a bit. So of course, right now, of course, I think we've covered the first question I was probably going to ask you anyway, in terms of ways to fight inflation, because we just spoken about, you know, simple ways to invest. Maybe there's something you can add to this, I'm not sure, but of course you've seen how energy prices are rising, fuel prices are rising, groceries, inflation is everywhere. You know, and of course, what I was going to ask is, what are some ways that you can, what specific ways of investing would you recommend that can help to fight against inflation? But I think we've spoken on stocks, spoken on ISAs. If there's one more recommendation or a piece of advice you can add to that, then please feel free.
Well, I guess I think it's more just about you know, getting familiar with investing for the long term. Because we are seeing a bit of a crisis at the moment with inflation, you know, jumping to very high levels, expected to potentially increase above 10%, you know, something we haven't seen, I don't think we've ever seen in our kind of lifetime, to be fair. And, you know, I think it is about getting into the mindset of this stuff, you know, in terms of a recession. You know, we do tend to see this every maybe 5 to 10 years or so, and we then tend to see a bit of recovery. So this isn't the end all of, you know, the markets or you know, the way your lifestyle standards of living is going to be. So I think it is about just finding a way to start regularly getting into investing and getting comfortable with the idea of putting your money in the market over time, and trying to take advantage of that compound interest over time as well. So a lot of it isn't just about the short-term solutions, because you know, inflation is already at quite high levels. It's going to take, you know, some really good growth from either key active fund managers or you know, passive portfolios that are going to outperform the market significantly to make a difference. And at the moment, you know, the markets are down. So it's not that realistic to assume that there's a magic investment that everyone's going to go into and they're just going to beat inflation straight away. So I think you need to be a bit more patient, but be comfortable with where you're putting your money.
Yeah, it's a good point you made. I think, is it Warren Buffett that talks about, maybe one of you guys will probably to finish this off for me. He talks about when he's talking about being greedy. So when everyone's trying to invest in a certain way,
there's a greedy.
There you go.
Greedy when others are fearful.
That's it. Yeah. So I think sometimes that's a good way to know where to run in terms of like investing. I mean, from what I've heard, like, it's a good kind of rule of thumb. But of course, I could be wrong. Yeah, of course, you guys know better than me. But yeah, that's a very, very good point there. We do have some questions come in. Once again, if you guys have questions, please do get them in for the panel. You know, they're here with us for the best part of just under 40 minutes. So please get your questions in before it's too late. And do hit that like button if you're watching on YouTube, Facebook, or LinkedIn, so more people can get this content. So Isaac's just dropped a question. What up, Isaac? Thank you so much. He was with us on season 3. So Isaac says, if you were to invest in real estate, would you opt for the UK or the continent first? Both of you can take this. Kwasi, I'm also curious to hear your ideas behind this, as well, as I know you've been doing some traveling as well.
Yeah, that's a great question, Isaac. Thank you for the question. Just to go back on a couple of points, though, when we're talking about inflation, I just in reality, so we talked about stocks and shares, ISAs, etc. Those are ways that you can invest and grow wealth, but that doesn't necessarily mean that you're going to beat inflation. Remember that inflation is the general cost of rises happening over time. So to beat inflation, the stock price needs to go up by more than inflation, because inflation is always going up. That's the first point I just wanted to point out. Just because you invest doesn't mean you beat inflation. There are fundamentally about... That's
hilarious. It's true. It's not that easy. It's not that simple. It has to exceed what the inflation price is, because if it's not, because it's going to catch up. Yeah. Sorry, continue.
I mean, but you know, just to double click on that, you know, like Michael rightly points out, inflation is probably 6.7%. Bank of England said it's probably going to be closer to 10%. I think it's going to be higher than that personally, or unofficially or officially. Actually, inflation. One thing that people always forget is that it's expensive to be poor. Inflation at the poor end of things, we're talking about 6%. It's probably more than 50%. Give you an example. If you go to Asda and want to buy their basic pasta, so not the one that's been flown in from Italy and it's all different colors. I'm talking about the own brand basic pasta. The price of that has gone up 50%.
Mad.
Right. So, you know, the inflation is really an average, but nobody is an average. Nothing is average. Everything is always one or the other. And that 6.7% is everything averaged in, but some things in that bucket are 50%. Some things are maybe 1 or 2%.
Yeah, I agree.
Are 6.7%.
You need to look at your basket as well. You know, it's the same thing. For me, inflation is when I go down to the local and I see bread costing £1.29 when it used to be 89p. That's the one that always stresses me out when I walk into the shop and I'm like, why is bread so expensive? You know what I mean?
The basic things, right?
Yeah, it's the basic things. But these are the things that creep up on you because these are the things that you're regularly buying. If you're not doing the bulk buy, if you're not going to the Lidl, the Asda, the Tesco's and doing the bulk buy, and you go to the local shop, it all starts to add up. You know what I mean? And these are the small expenses that creep up on people that they're not really keeping an eye on, and they don't understand that for them, inflation might be 20%, it might be 30%.
Exactly.
Because of
so I think so it's important to bear that but when we talk about investing, I think there are many things you can invest in, but fundamentally there are only three things that really beat inflation, and none of those three is gold, to be clear. People often talk about gold being a great hedge against inflation, but factually it's not based on the data. So if you really want to beat inflation, there's two things that probably you will know about, which is real estate. I'll come back to that and I'll answer Isaac's question. The other one is commodities. So when I talk about commodities, I'm talking about things like oil, rare minerals, metals, other stuff. You know, we can't go and buy a barrel of oil and come keep it in our back garden. Or I'm not really about to go buy some, you know, palladium or whatever and store it. That's where the previous conversation around ETFs comes in, exchange traded funds, which were mentioned. So you can get ETFs for commodities, either as a basket of commodities or specific commodities. So commodities are number two. And then the third thing, which most people don't really know or care about, something called TIPS. It's a type of bond. And it's from the Treasury, the US, and it's inflation protected Treasury bonds, basically. And so those were effectively, they give you a return inflation plus. So whatever inflation is, they'll give you that plus whatever. So those are the three ways that you can beat inflation. Coming back to real estate, I think real estate, one of the main reasons why real estate tends to beat inflation is because of leverage, borrowing money to buy an asset, which you then only pay for the repayments on the mortgage and you get the income. The problem there is that you can possibly inflate away the debt. So if you have a debt and you're paying a fixed return on that debt and inflation is going up, then in real terms, the value of that debt stays the same, but obviously inflation is going up. So you're deflating away the debt, if that makes sense. The problem with that argument actually we're talking about here is that in an inflationary market, everything else is going up. We haven't touched on this, but interest rates are the core thing. I mentioned that the best thing about property you buy with leverage. We've been living in a low interest rate environment for the last 15 years since I started working, basically.
True.
But now interest rates are going up. They've gone up from 0.1% to nearly 1% in the space of about 3 months, right? And the only direction of travel is up. So that's going to impact the return on real estate if you're buying with leverage. And that's something that's really important to understand. Location. So would I buy in the UK or would I buy on the continent first? I mean, there's two ways to look at this. So generally, I think when you're buying real estate, the location is important only insofar as we have strategy. It doesn't matter whether I buy on the continent or UK first. It just depends what strategy I want to apply. If I want something that is going to be like, if I want to buy something that is going to be relatively hands off, I'm gonna, maybe I have euros sitting around in a foreign currency that I'm investing, and I don't need pounds, so the exchange rate doesn't matter. So if the money comes back to me in euros and it's gone down by 10% every week, that doesn't matter to me. All of those things are what I consider. I don't think I would do both is the simple answer. UK and continent, not one or the other.
But what if the money is limited? What have you got to choose one? What have you got to choose one? You can't have both sometimes. As much as I like to buy both rather than just setting it for one thing.
I guess for me, my dad's always said to me, you know, if I wanna do business in Ghana, for example, I need to be there. And that was the one thing that's, if anything's held me back from, you know, investing in that area, because I haven't actively been running back and forth there as I would like. So I think it really does depend on your preference, you know, and I think you need to think about your long-term prospects with this as well. Where do you plan to be in the long term? If you're planning to go back to the continent, is that a place that, although you may be renting out now or using for investment purposes now, are you planning to live in it later? So what does that look like? Are you buying a hotel? Are you buying part of a hotel? And, you know, Kwasi mentioned as well about the currency exchange rate. You know, the money might not go that great when it's coming back to the UK. Do you know what I mean? So it really depends on what you're trying to do for the long term, and where you're planning to use that money. Because a lot of people focus on getting into the investment, but a lot of people don't think about the exit strategy of the investment,
or even the holding. Like, you know, you're so right. People don't think about the exit strategy, but to be honest, people don't even think about the holding period. All they want to do is, I want to get into an investment, but once you have it and you're in it, you then have to hold it. And then, as you say, Michael, you then have to exit. So yeah, such a good point that, you know, entry, holding period, exit are all key.
And holding is just as important, because even if we talk about real estate in the UK, you know, the London is probably one of the biggest places in the UK where people are investing in property, and so much so it's even more than pensions in the UK. But if you talk to a lot of people that are investing in property in London, they're not all making money in the short term because of the additional costs that they need to take into account when they're renting out the property. If they own it, some people are becoming accidental landlords because of the fact that they've either received property for inheritance, or they decided to invest in real estate, and they're not taking into account the real value of the investment from a net perspective. So we've got the gross rental income, but we also need to take into account the fees, the mortgage, any other costs, and then tax.
There you go. Tax. The biggest thing of them all, right?
Yeah.
The Grim Reaper himself.
It's coming for all of us. You know what I mean? So death and taxes.
The problem with tax is that it's coming for property.
Two things certain in life: death and taxes. Right? Who said that? Remember? I remember who said that.
I think it was Rockefeller. But the problem with property is that the problem with taxes is that they're coming for property investors in a different kind of way. Especially in the UK. So maybe that part answers your question, Isaac. The one thing that would attract me to the continent or to anywhere else is the tax situation. In places like America or anywhere in the world, when you have a property and you pay a mortgage on the property, you're able to deduct that mortgage from your costs, from your overall cost of running the business, and then whatever's left is your profit, and that's what you pay interest. You pay tax on. So you have your income, you deduct all your costs, whether that's mortgage, repairs, handyman services, local taxes, council tax. Deduct all of that. You have a number left over, and then you pay tax as a percentage of that, 20% of that.
It's crazy.
The problem with property is that the biggest cost in property is your mortgage. So your mortgage will probably make up sometimes up to 50% of your overall costs. Now, that's not an allowable expense for tax purposes. So even though you're paying that mortgage, according to the tax man, that's profit in your pocket, and they use that to calculate your tax. You could end up basically paying more tax than you're making in profit.
It's crazy. It's absolutely savage.
Yeah.
It's so savage, the system. It's so savage, the system. Beauty Stick says it's a personal choice, no right or wrong answer. Interesting.
Yeah, I agree with that.
And Beauty Stick says the quests didn't touch on interest rates, ISAs, or ready-made portfolios. Interesting.
They want to know about the interest rates on them.
Do you want to know about the interest rates on them, Beauty Stick? Let us know. Okay.
I mean, it
this
varies.
go on.
Do you want me to answer that, or
Yeah, if you want to, if you can
so
answer that.
the simplest answer is cash ISAs are not giving you anything. You know,
I thought as much.
they're interest rates are low. You know, the banks are not really divvying out any credits or any interest at the moment. So cash ISAs are tied to the interest that the bank is providing for those accounts. If we're talking about investment ISAs, stocks and shares ISAs, then we're actually talking about the ETFs and the index trackers that Kwasi mentioned, and the returns are based on those investments, not the actual wrapper itself. So a lot of that is dictated by who's putting the investment in the portfolio. So if you're a novice, you might get novice returns. You know, if you're expert, you might get expert returns if you know which funds that you're putting in there. So you just need to be very conscious of that. A lot of that is driven by, you know, the advisor, someone like myself, or the fund manager, or the individual. Could be you.
Very, very good points there. Thank you for sharing that, Michael. All right, guys. So, I mean, I can see there's quite a number of people online. Those of you that's joined us, thank you for joining us. We're having a discussion on property and finance. So, what we're looking at is ways you can utilize your existing funds, your cash, how you can leverage property, and how you can make certain financial investments to try and get ahead of the curve in terms of inflation and a possible incoming recession and the current economic uncertainty at the moment that's spurring. It's half time. We're going to go into a quick break. What we're going to do is we're going to do a little quick of a flashback into a quick conversation I had with Kwasi. It's only going to be a few seconds, and then when we come back, we're going to take more of your questions and we're going to continue this conversation that we're having. Please do not go anywhere. Once again, please hit the like button wherever you listen on YouTube, LinkedIn, or Facebook. And do get your questions in if you have questions about property and finance. Please keep it locked here on the Sound of Accra podcast.
Uncle says cash is trash.
Unless you can leverage against it. So a company like Apple, the reason why they keep cash on the balance sheet is because they can leverage against it. So let's say they have 100 million.
Yeah.
That means that they can borrow probably about 80% of that.
That's huge. That's huge. Yeah.
So it depends. This is all financial engineering.
Yeah.
But I think the key thing is for a company like Apple,
financial engineering. Some people, that term will probably go over some people's heads, but anyway, I know exactly what you mean. It's all about leverage, yeah?
Yeah.
It's all about leverage, yeah. And same thing, football clubs, people that buy football clubs, you know, they probably take these big loans and, you know, even though they got money, they're going to use someone else's money to then, you know how
one of the best football deals to pivot is the Glazers buying Manchester United. Yeah. And I mean, like, if you're interested or if you're listening to this and you want to understand a little bit about financial engineering, do use that as a case study. Just Google and read. Like,
that was one of my favorite conversations from season 2. That's me and Kwasi from season 2 episode of the Sound of Accra podcast. If you guys want to go listen to the full episode, just head over to thesoundofacra.com/Kwasi. The link is in the chat. We will get to a clip with Michael soon. Don't you worry, guys. And Kwasi also has a podcast. What's your podcast called? It's Slow Money. Is it the Slow Money Podcast?
That's the one. Slow Money Podcast on iTunes and all other podcast players.
Slow Money Podcast.
Yeah, so, where you can learn to turn dreams into income streams.
Woo! It's just so catchy. I love it. I absolutely love it. So I've just put the link in the chat. So the Slow Money Podcast. Just go and check it out. Check it out on iTunes. Kwasi has some fantastic guests on there, and he does some events as well. So please check them out. If you're watching on YouTube, LinkedIn, or Facebook, if you check the description below, you're gonna have all of Kwasi's links. And of course, you can have all of Michael's links if you want to get in touch with them, listen to a previous show, or you want to work together with them. Okay, so let's keep this conversation going. So we were just talking about real estate and property. Isaac, if you're still watching, thanks again for your question. I really do appreciate it. Those of you that's joined us, thank you again. Please let us know where you're tuning in from. If you have any questions for Michael and Kwasi in relation to property, finance, investing, please do get it in the description. And let's keep this conversation going. undoing amazing, Adrian. Okay, Isaac says we'll definitely check out the Slow Money podcast. Thank you so much. Go check it out.
Right.
You know, so if you want to turn those dreams into income streams, Miss S Otto says undoing amazing, Adrian. Thank you so much. Thank you for tuning in. All right, so this is a nice question for both of you. I think it's a nice segue from the conversation we just finished off before we went into that quick little break. So this is an interesting one. So at the current economic climate, is it easier just to keep renting and then to hold out before buying a property in the UK, or just even in general, maybe in the world? This could apply to anywhere in the world. Is it better to hold out because of the current economic climate? Is it better to hold out to buy a property to get the property ladder, or is there always a good time to buy a property based on the circumstances of the purchase? Kwasi and Michael, you can both take this because I know you can both take this one.
I mean, I'll probably just start by saying I think the opportunity you have here is before interest rates start to rise up. If you're in a good position to get a good mortgage, because this is what we're talking about. We're talking about buying a property, but again, leverage. We're talking about potentially needing a mortgage to buy that property. With interest rates being at these lows, they're starting to pick up. You might want to look at getting a good fixed rate in for a period of time before we start to see an increase, because one of the key things that the government is going to try and do, and probably need to do, and it's already happening globally, is raise interest rates to try and beat off inflation. We're seeing it across the board in the US, we're seeing it in Africa, we're seeing it in South America. It's happening. So if you're in a position to do that, then try and take advantage of it. Even if the mortgage was higher than the rent, but I think you just need to make sure that you got a good balance there, because you got to start thinking about what it might look like in the next couple of years.
So it's long term. So you got to look out the long term at the end of the day.
Yeah, I think for me, sorry, Michael. For me, one of the things that I always think about is my own experience. There's two ways. This question people ask a lot. There's two ways to answer it. I always want to own before anything else when it comes to an appreciating asset. So if it was something like a car, you don't technically really want to own a car unless it's going up in value. Ironically, my car's going up in value. We'll talk about that later. You don't want to own anything unless it's going to go up in value. And is a property going to go up in value? Yes. So really what you want to do is own it. The renting is a good option. I know some people actually who renting is a good option if you own already. Renting where you live, but owning somewhere else, which is different. Then we're getting into a bit more of an advanced discussion where actually you can live in somewhere like London, maybe live in zone 1 or 2 in central London in a penthouse apartment and rent that and have a great lifestyle overlooking Hyde Park. Then own 2 or 3 properties outside London that are rented out and generating income, which is supporting and paying for where you're living now. So my preference is always to own. Even if you're renting, you should be owning first, and the place where you're renting should be enough to support the place. The place you're owning, should be enough to support the place that you're renting. But that's always my suggestion.
That's a great idea. So basically, the place that you own is going to generate the cash flow to hopefully pay for the place that you're renting. So essentially, you're living for free. In a way.
I mean, it's a lifestyle hack, as they call it, and that's ultimately like it could work the same. You could own property in the UK but rent somewhere in Ghana, for example, and that's the same. You have the places that you own which are appreciating in equity, they're going up in value. You're generating income from them passively, and you're able to rent, and they cover at least even if they're not covering all of it, they're covering part of it. Totally different scenario. So my preference is always own first, and then you can do whatever you want with that.
It's a good one. I mean, it's definitely a good one, and I think those that want to rent where they don't own, and buy where they don't rent, where they're not living, I think there's a flexibility to it as well, where you can move as and when. Whereas when you're buying and you're living where you own, you're more kind of tied to that, and sometimes even you get emotionally attached to it. so it's harder for you to kind of like maybe want to move out if you feel like you need to move out for financial reasons or lifestyle reasons, etc. I don't know if you wanted to say something, Michael? I don't know. I think you've already said something.
I think just very quickly, I think it's just about the lifestyle choices as well, because like you said, it really depends on what you're trying to do, what you're trying to achieve. Some people are thinking about the idea, especially with what's happened with the pandemic. Some people are ready to move abroad. Some people are ready to go to a different country and maybe go rent over there. And if they're already renting, they don't have I wouldn't say that baggage, but they have that investment behind them, which they have to keep an eye on, make sure that they're getting some money off the back of that. If they have a preference to that, then that's fine. If they don't, then they can easily just transition from one place to another, get up and leave and go over there. So it again, these things are not just clean cut in the way to address it, because it really depends on what you're trying to do. And I guess if we're looking at it from a generational wealth perspective, the reason why I agree with Kwasi from in terms of having ownership is because this is about building something that you can potentially pass on to the next generation. And if you are regularly going out to rent on your own, you're now having to build on your own, which means you have to wait to accumulate that deposit by yourself. Whereas a lot of our counterparts, a lot of the Asian community, the Jewish community, all the other communities, they usually tend to build together before they branch out and buy their own place. Where we tend to kind of leave the nest earlier and rent first, and then we are having to catch up by paying rent and building a deposit. We're not doing it together.
Yeah, it just shows the contrast between the Asian community and the Black community. The Black community is a bit more flashy, a bit more independent, whereas the Asian community, they're more collective, they're more let's build together, let's grow together. And when you see the amount of properties they have in their portfolio compared to maybe the average Black family, sometimes it's or even the amount of disposable income that they have available compared to the Black family, it's the average Black family is crazy. It's absolutely ridiculous. Those are very, very good points that you've made there. Very, very good ones. Okay, BFS. Miss S. Otto says, I think a good review of your finances is important and forecast what works best for your pockets, not trying to be like everyone else, focusing your journey. I can echo that. Thank you for that comment, lovely comment, Miss Otto. I can definitely echo that. And I guess it's a bit similar to what this lady said, Beauty Stick said earlier on. Like she said there's a personal choice, no right, no wrong answer. I guess in the days, it's also down to the person's, lifestyle and what they want to go after, what they want to pursue.
I mean, I think Michael touched on this, and I just want to drill down on it because it is a lifestyle choice, but, and this is a big but.
Go on.
The median wealth from property for the average Black family in the UK is zero.
You shared an article about that a while ago.
Yeah, I've shared the article about that, and this is something that really does my head in. There's an article in Bloomberg. You can Google Bloomberg, Google how London's Black property boom left Black people behind, or something. I think is the subject.
Yeah, that's the one I remember.
But they did the research, and which showed that median. So we talked earlier about averages. Inflation as an average is 6.7%, but on some of it it's 50%. And some of it will be less. So it's similarly the median, the average amount, the middle amount that Black families, if you lined all the Black families in the UK that have houses and had built wealth from them, the median value would be zero. Oof. And I think if I remember correctly, the equivalent for Asian families was I think Asian families were top, and the equivalent for them was something in the region of 170,000.
It's crazy.
That's how much wealth that they've made. So Black family zero, Asian family 170K. So it's a lifestyle choice, and that lifestyle choice leads to erosion of wealth as opposed to wealth creation.
Yeah.
Choose wisely.
Choose wisely, ladies and gentlemen. Choose wisely. Okay, that's a very good conversation. Those of you that engaged with comments, thank you so much. Thanks for tuning in, guys, so far. I can see there's quite a few people that we have online. So you have the best part of maybe about just over 10 minutes left. If you guys have any final questions for our panel, Michael and Kwasi, they've definitely dropped some gems in. Please get them in. And if you just joined, thank you so much. We're having a discussion on property and finance, looking at ways to navigate a little bit of uncertainty as we go through a period of inflation. Please do hit the like button and get any comments. Let us know where you're listening from, and let us know if you have any questions for the panel. Let's keep this conversation going. This is another question I've got for both of you, right? So of course we spoke earlier on about interest rates, right? How high do you think the interest rates can go high? Maybe I don't know how well you guys know the American market, but I mean, right now let's talk about the UK market. I mean, maybe the terms of the Bank of England. How high do you think interest rates could hit based on the current pace that things are going up on by Q4, by the end of the year?
You want to go first, Michael?
Yeah, I guess it's a tricky one, but I think a lot of it's to do with targets for the government. You know, they're naturally trying to get inflation down, and their average tends to be around 2 to 3%. And for them to do that, you know, in terms of raising interest rates, they're probably going to need to do it quite dramatically, but also try and not do it in a way that's going to kind of trigger another shock to the economy as such. So,
Yeah,
you know, I wouldn't be surprised if they are trying to kind of get up to the levels of, you know, 4 or 5%. I mean, I think there has been some articles talking about the aim is to get close to 3 to 4% realistically. But then I think it's all dictated on how fast the inflation is able to move back down, and that's going to be one of the key indicators of it, because it starts to have a spiral effect on everything else in mortgages, again.
Absolutely.
Which we're talking about property, and you know, we could be sitting here and talking about a good opportunity to get a mortgage now, and all of a sudden interest rates are 4 or 5%, and bam, you know, all the mortgages start to disappear from the market, or it's just not feasible for everyone. So it can really change things very quickly if you're not careful.
Yeah, and that's why I asked that question in terms of is it better to hold out in terms of getting on the property ladder, buying the property, you know, or is it better to just do it based on the circumstance and based on, you know, the property strategy that you can use? Maybe we can touch upon one or two before we close out, because I mean, interest rates rising is going to mean maybe those that took out help to buy, you know, mortgage, whatever, you know, they could be affected, you know, a lot more than others that took maybe like a normal mortgage, and maybe those that didn't secure really low, you know, mortgage rates are going to get hit, you know. So it's very interesting what the ripple impact is going to have, you know, towards the end of the year. Don't know if you wanted to add to that, Kwasi. I think you're mute. Are you mute or? Okay, I think he's still on mute. Hold on, Michael, can you hear me?
Yeah.
Sorry, am I still on mute?
You're back. You're back. Perfect.
You're back.
Yeah,
there you go.
You're
Sorry
back.
about that. I was on mute. In terms of what could happen with interest rates, it really depends what happens with inflation. I think Michael was alluding to this. The reason why, from a kind of monetary policy perspective, the only thing that the Bank of England really can do, the only tool that they have literally to tackle inflation is rising interest rates. Yeah. Everything else that they do and have done has really contributed to inflation. So quantitative easing, printing money, which they've been doing for the best part of almost 2 decades now. And then you had all of the pandemic relief measures.
Oh my gosh, that's going to hit us in the back. And I think that for the Americans as well, the stimulus and the stimulus, especially because we have US listeners as well, the stimulus as well, similar thing out there as well, isn't it?
Same outcome. So the stimulus that they had, giving $1,000 checks to everybody, which helped the crypto. You mentioned crypto earlier. I think that helped the crypto market a lot.
Of course, because you can just reinvest it into the crypto.
Yeah.
I don't know if I
Inflation
call that an
was in the
investment.
crypto market, one in their food and and baskets. It was in the crypto
Dogecoin
market.
millionaires and all sorts. It's just insane, man. We've all been enjoying
So
it.
I think
Anyway.
like a lot of the pandemic relief measures globally will have contributed to the high inflationary environment that we are seeing. So that unfortunately, obviously, the Bank of England can't affect any of that, and all of the stuff the government has done, not the Bank of England, like giving bounce back loans in the UK, furlough payments, giving people 80% of money for staying at home during the pandemic, C-bills, all of this monetary easing has gone into people's pockets. Direct monetary easing is what we call it. Really, it's just putting money into people's pockets. What are they going to do? They're going to spend it, and that's going to add to the demand side. And then on the flip side of it, you've got all of the supply constraints, whether it's from 2 years ago when the pandemic happened and everything shut down, whether it's from this year, the war in Ukraine versus Russia, which is having massive impacts on stuff. Inflation is going to keep going up because, in fact, actually, the Bank of England governor said this, and he made it. It was a stupid comment to make, but I totally agree with the sentiment that there's going to be apocalyptic food crisis and shortages coming in the beginning of next year.
Even
Ukraine
last year.
Even last year, but last year is nothing compared to this year, my friend.
Of course.
I think if you take last year and how much things went up by, Ukraine is the biggest producer of grain in the world, and they haven't been able to export any since February. So the thing what happens is people buy things in forward contracts. So if you want to buy grain, you probably buy 2022's worth of grain in 2021. So that means people are buying this year for next year. That means all the cost pressures are going to push into next year. What's that going to mean for inflation? It's going to go up. Back to your point, right? So the Bank of England only has interest rates, which have nothing to do with anything that I've just said. And that's the only thing it can do to affect inflation. To Michael's point, though, right? In I think it was early 90s, inflation interest rates were at 10%.
Yeah.
Pandemic, they were at 0.1%. Right? Are we ever going to get to that 10%? No time soon, because fundamentally, not everyone, most of the people who have mortgages, anybody like me, I finished university in 2007, in 2006, got my first job, anybody who's bought their house after the global pandemic doesn't know interest rates higher than a couple of percent. So, I don't think, I can't imagine.
It's a good point. Oh my gosh.
I can't imagine how they'd cope with, Michael mentioned 5%. I can't imagine how they'd cope with a 5% interest rate rise. That would be like, 3-4 times what they've ever been used to. So their mortgage payments would be 4 times what it was when they originally got the property.
Yeah.
So I think these are the competing, I guess I'm just explaining the competing pressures. And this isn't just in the UK. This is going to happen all over the world, right? The same challenges, the same macroeconomic challenges apply. So whether it's the US or here, when they start increasing the interest rate, it's going to affect all of these consumers who have credit cards, who have mortgages. And so there's going to be, this is moving, I like the economics more than I like the politics, but this is moving from the economics to the politics, where they're going to be like, actually, the government won't be able to, we've got an election in 2 years, they won't be able to increase interest rates to 3% because the people that it's going to hit won't vote for them. So fundamentally, there's the kind of what the Bank of England governor Andrew Bailey needs to do and wants to do, which is their prediction that I think actually interest rates probably should go to closer to 5%.
5%.
In real terms, it's been so low, artificially low for 15 years. Before the before the financial crisis, they were normally between 4 and 5% for the best part of 2 decades. And then we've had the last 2 decades where they've been less than 1%, closer to 0.5%. So I think we're probably going to go up, but I just don't think, I think we're talking about the next decade, the 20s, where we're going to have to get to a normal rate of interest. But in the short term, the next couple of years, it will go up, it will hurt people, but I don't think it's going to go up too much because that's where the politics is going to be the showstopper.
Perfect, makes perfect sense. Very, very good points there, Kwasi. Very, very good points. I think, these things there's always cycles, there's economic cycles, and I think these things can only go up for a certain time and then they go down and then the cycle starts again. So it's going to be interesting to see how things turn out. So we've got a couple comments here. Miss S. Otto, thanks again for your comments. It's absolutely awesome to see the black men of my generation shining and dripping with such relevant knowledge. Goats. Jeez. Okay, and we have a question from Abina. I hope you're still on the call. She says, not on the video, sorry. She says, what's the best average deposit you would recommend for a first-time buyer in London? Any crazy, you can take that, Michael, if you want to jump in, feel free.
I mean, I think the best is such a subjective term.
Oh, man.
The best deposit is the most deposit that you can get. Yeah. The best deposit is the most deposit you can get. That's fun. Like if you've got money for the deposit, don't hold that back, because that's going to reduce your mortgage. It's going to reduce your payments. You're going to get a lower interest rate because you have a lower lending to valuation. But for me personally, when I'm looking at a mortgage, I normally aim for somewhere between 75 and 80% LTV. LTV is the lending to valuation. So I want to borrow about 75% of the property value to 80%. I think beyond that threshold, then the cost of finance for me goes up a lot more. And then below that threshold, the cost of finance is really cheap. But then you're talking like every percent, depending on the value of the property, every percentage is something like another 3 or 4 grand. So about finding that balance, I guess. So for me, it's normally around 75 to 80% valuation. So 20 to 25% deposit.
Yeah, and I think it also depends on the mortgage company as well, isn't it? Because some mortgage companies, they want 25%, some 20, some 15, but 50 is not very often.
Even with the same mortgage company, they have different products that have different LTVs, and depending on the LTV, you get different interest rates, different costs, different charges. So it's fine balance, but I think that 75 to 80% mark for me is kind of like the sweet spot.
Yeah, I mean, I think Santander are starting to provide mortgages to, or more willing, I should say, to provide mortgages to self-employed people.
That's really interesting.
That changes the dynamics of maybe how much they need as a deposit, and whether they're even in that bracket to get a mortgage where they probably weren't in before. So the market is always changing, and Kwasi said it, the more you can put down, the better it is for you. But it will vary depending on what you're trying to buy, how much the value of the property is, and also, how much the mortgage is going to be. And again, it's about thinking about the holding periods. I like what Kwasi said earlier, because the holding periods, some people are ready to get the deposit down and buy the mortgage and sit in the house, and then they got to figure out how to pay the mortgage. And it's sure, at that point you'll probably try and figure it out, but it's a lot of pressure. It can be a lot of pressure on you, especially if you're doing it by yourself. Like I said, if you're not part of the household, in terms of the household income, the Black community are seeing much low averages in comparison to the Asian and the whites and all the other counterparts. And what that means is, if you are buying, this mortgage is a mortgage that you're committing to for the next 20 odd years, whatever that looks like, and you got to make sure that that is a good amount that you can afford. And usually that's more than 50% of some people's income a lot of the time. So just think, it's good to have that under your belt, but it can take a toll on your lifestyle and your day-to-day. So you really need to think about what that looks like for you.
Yeah, I guess it circles back to that question. It doesn't make more sense to rent or to buy based on your circumstances. And I think we're going to end it there. Kwasi, Michael, you've been fantastic panelists. Again, the audience has, showered you with appraisals. So, well done to you guys. Thank you so much for spending time with me and to share some gems with the audience. So guys, thank you so much for tuning in. Michael, Kwasi, where can the audience learn more about you? But before we do that, actually, if you guys want to listen back to the episodes I did with Kwasi and Michael, you can head over to thesoundofcrowd.com/Michael Donkor. If you listen back to my episode with Michael back in season 2, it's called Making Wealth Accessible. It's also available on Apple, Spotify, and YouTube as well. And all of the links that Michael will be in that link as well. So if you want to get everything in one place, feel free to visit that site. And also the same for Kwasi, soundofcard.com/Kwasi. We had a chat about slow money and fintech. Please head over to that link and you'll be able to watch or listen back to my conversation with Kwasi, and then you'll also be able to find links and references from the episode, and also information about how you can get in touch with Kwasi on that. But apart from that, if there's any other links or announcements you guys want to make, please feel free before we close out.
Kwasi,
Michael. Thank you, sir. I mean, there's nothing else really. Just, I think you have all the links. I just want to say thanks. I guess, I should say thanks to Adrian for having us and for bringing us on, and making this all happen.
Definitely.
Pleasure.
Yeah,
Pleasure.
same, man. I appreciate it. And you can find me on LinkedIn, Michael Donkor, and my website, michaelgdonkor.com. So you can just tap into that. And if you want to reach out to me, just send a message, and then we can catch up.
So michaelgdonkor.com, head over to the website, book a consultation, get in touch with Michael. He's your man. He's your financial advisor. And guys, thank you again for tuning in. I think we will close out with a little clip from season 2 that I had with Michael. And then, we will be back with a live Q&A session sometime soon. But other than that, keep it tuned here at Sound of Accra podcast. Thank you so much, guys. Thank you so much. What was Switzerland like? Different financial culture, I can imagine. Different regulations.
Yeah, different culture. I think, people are a bit more, they're a bit more comfortable in terms of speaking with you. But when it comes to finances, they don't waste time. They're very direct.
Wow.
They didn't beat around the bush.
Yeah.
If they're not happy, they'll tell you. They don't want to get involved in anything, they'll tell you. A lot of people in the UK, from our experience, will kind of play that carrot and stick kind of scenario. They'll dangle a lot of stuff in front of you, and then you go through the process with them, and they'll go, I'm not really interested. Or, I don't have any money.
Yeah,
that kind of stuff. And
exactly.
out there is, I'm interested. I'm not interested.
That's they just tell you it's a bit more of American culture, right? Because with America, I think American culture is different to British culture. With British culture, a bit more reserved. You